We appreciate everyone carving time out of your very, very busy schedules this morning to join us, to join Advent and two of my other colleagues for our seminar where we'll talk about the opportunities in convertibles. We'll talk about the momentum we're seeing. We'll provide a market update and a brief overview of our strategies. So we really, really appreciate people carving out the time. We hope you find the next 45 or so minutes to be insightful, to be productive, and really most importantly, to be value added as you all think about navigating the current markets, sort of in the next market cycle for the portfolios you oversee. Just by way of background, my name is Scott Reed. I'm the COO of Advent Capital. I've been with the firm for about 4.5 years. I have about 25 years of experience in the industry. I'm joined by my colleague, Craig Altschuler, who oversees our client and consulting relations for the firm, who's been with the firm for about 9 years, who many of you know. I'm also joined by my colleague, David Hume, who's a senior portfolio manager of our balance strategy. And David's been with the firm for 19 years. And so you'll hear from all three of us over the course of the next 40 or 45 minutes. In terms of just so you know, sort of who's here, who's attending, we've got a wide range of really outstanding, high quality attendees for this event. And the attendee pool is very, very similar to the interest level that we've continued to see over the course, particularly of the last 5 quarters, year and a half in our platform. You represent a wide range of corporate and public pensions, insurance companies, healthcare systems, some private investors, as well as senior advisors and consultants to some of these groups. I probably haven't covered the entire audience, but that's really just so you know kind of what the demographic looks like of who's attending. And just maybe one point of clarification, as this webinar goes on, you will see at the bottom of your screen, many of you have done this before, we've all been doing this, a Q&A function at the bottom of your screen. We will have what we hope will be an active Q&A session towards the end of this, end of the presentation. So as you have questions that may appear, please type them into the Q&A function, and we will try to address as many of these questions at the end as possible. And in terms of today, what we're really planning to do, quite simply, is to address kind of 3 primary topics. I'm going to provide a brief overview and update of Advent and our platform. I will then transition to Craig, who will provide a brief introduction and overview of the convertible market, a market update, and very importantly, he will also talk about the sort of the age-old question of where do convertibles fit in client portfolios. Craig has a lot of experience working with many of our clients to address that very specific question of what are they and where do they fit in a client portfolio. And then we'll transition to David, who will provide an overview of our 2 core investment strategies. So that's really the plan. And as I mentioned, at the end, we hope to have an active Q&A session. So again, please feel free to type in throughout the seminar or throughout the webinar, and we'll address your questions as that evolves. So with respect to Advent, maybe just let's proceed. Many of you are familiar with the firm. I think most all of you are familiar with the firm. But just a couple reminders. Advent's been around for 25 years. It was founded by Tracy Maitland in 1995, really to focus exclusively on the convertible asset class. Tracy saw a tremendous problem when he was at Merrill Lynch, and he sought out to address that, to try to provide a solution, which is where do convertibles fit? And so when Tracy founded the firm, he he founded two core strategies: a defensive convertible solution for people who want an enhanced fixed income, and more of an equity-sensitive convertible solution and strategy for people who wanted more defensive equity. You'll hear more about that later. Today, the firm is at peak assets. We've had very strong interest across the platform with 58 total people in New York and London with 20 investment professionals. And we are, as I mentioned earlier, we are specialists in the convertible asset class. So I think that's important to take away. I think many of you know that, but we're not trying to do really other things. Everything we do is synergistic with our core convertible strategies. Moving forward, in terms of, I want to just spend a moment on diversity and inclusion. As many of you know, we are a minority-owned firm, and I just want to highlight at the beginning that diversity and inclusion is not a new concept at Advent. This is not something that we started focusing on 14 months ago or 15 months ago. This is something that has been really core to who we are since the firm was founded. Certainly the attention that the broader community is paying to these very important topics is relevant. But I just want to emphasize that this is not, we didn't hire a diversity and inclusion consultant a year ago to give us the roadmap for how to address this thing. This is part of our core fabric and really always has been. As you see here, a couple of highlights: about 60% of the firm today is either diverse or female. So that's a pretty powerful comment. Collaboration and inclusion across the platform is critical to how we operate. We really insist upon, even in this COVID environment, the Zoom environment, we really focus on close, active collaboration between the groups, between people of different seniority, people of different professions. So the inclusive part of the D&I is as important to what we do as the diversity piece. And I think that's something I just want to highlight. And in terms of specifics, people say, what does that mean? Like, how do you incorporate this into your daily life? What specifically are you doing? We do a lot of different things. But to be clear, there are a few key areas that we always have focused on, and we certainly continue to focus on, in addition to other areas: hiring and providing opportunity. This is something that Advent, Tracy and Advent has, and we will all continue to focus on that, which is making sure we are providing employment opportunities, high quality employment opportunities across the platform for men, for women, for diverse candidates who typically are not necessarily as well represented in this business as we think they can and they should be. So we're very focused on the hiring, the recruiting, the retention as well, and promotion. So those are a couple key pieces. And over the course of the past 3 years, just to give you a fact, that's 61% of all the new hires over the last 3 years have been either female or diverse. So let me just transition briefly into a summary of the Advent platform today. I think many of you know we are a broad platform focused on convertibles. We have 3 core businesses. We have our alternative strategies on the left, which is roughly a little bit over that, roughly a $700 million business. We have our closed-end fund business on the right here, which is a New York Stock Exchange traded closed-end fund, ticker is AVK. And then what we're here to talk today about, to primarily focus, are our traditional strategies. As many of you know, our traditional strategies really represent the bread and butter of who Advent is and what we do day in, day out. We think these other 2 strategies are critical and vital, and we're excited about those, and we commit resources to those. But the traditional strategies, to be clear, represent about a little over 85% of the total assets that Advent manages. Today we run about 11.3 billion in assets. So you can kind of do the math, but that strategies, this piece is about 9.5, a little more than this, but $9.5 billion in total assets. And as I mentioned briefly earlier, and you'll hear more about it, we really have two distinct, I would call it flavors of converts. We have our balanced strategies, where David Hume is the PM for those, the senior PM for those strategies, which comes in 3 different flavors: unconstrained, investment grade average, and investment grade only. And these are strategies focused more on call it defensive equities, and providing kind of equity exposure to allocators. And then we have our Phoenix strategies. Our Phoenix strategy is a more defensive convertible strategy, where investors use this strategy really as an enhanced fixed income tool. So it's we have these two distinct strategies that help clients, help allocators use convertibles in distinct fashions for their portfolios. So with that, I'm going to transition the camera to Craig.
Thanks, Scott. And thanks to everyone participating in this webinar. Despite the strong long-term risk-adjusted returns and the more recent momentum we've seen in the convertible market over the past 18 months, we understand that convertibles are still not a mainstream asset class and require investors to think outside of the box. For that reason, we're especially thankful to those joining today and to those who end up listening to the replay. And I personally am excited to have the opportunity to provide you with, first, a better understanding of how convertibles work. Second, a historical and current snapshot of key market dynamics. And third, specific concrete answers to that million-dollar question Scott referenced earlier: where could convertibles fit into my already diversified portfolio? So let's get started on page 8. For those completely unfamiliar with the asset class, I'll spend a minute or so on this slide, which provides what we hope is a clear pictorial representation of a convertible. As you can see, a convertible, in its essence, is comprised of either a bond or a preferred, plus an embedded equity option. Given its bond features, most notably its coupon payments and return of principal at maturity, convertibles have been able to deliver equity-like returns with less risk than equities over time. Instead of buying an equity where you lose money when the stock price goes down and may never recoup those losses, when you invest in a convertible of that same company whose stock price declines, the convertible should not go down as much as the equity, and barring a default, which is a very infrequent occurrence in the convertible market, an investor will get their principal back at maturity. Turning to page 9, we can walk through with a chart how convertibles deliver this positive asymmetry. Let's first define the various lines in this chart. First, the solid diagonal red line labeled conversion value represents how much an investor would receive if they converted their convertible into common stock immediately. Next, we have the horizontal dotted black line labeled bond value. You'll also hear us refer to that as bond floor or investment value. That represents how much the convertible would be worth if you stripped out the conversion option and it was just a regular straight bond, where you receive a semi-annual coupon payment and your money back at maturity. Lastly, we have the hockey-shaped green line labeled convertible price, and that is how much the convertible security is worth at any point along the curve. So the key takeaways are, first, as you move to the right of the chart and the stock price of a particular company is on the rise, the convertible, or the green line, picks up more equity sensitivity and starts to converge with the equity value, or the red line, until you end up in the blue zone. I know I'm throwing a lot of colors at you guys, but the blue zone is where the convertible is essentially moving one for one with the stock price, both up and down. As a convertible holder in that blue zone, you no longer have sufficient downside protection, which kicks in when you reach the dotted black line, or the bond value. As the stock price declines, the convertible value, again, the dotted green line, starts to flatten out in that yellow zone, as the bond value, or bond floor, starts to kick in. And as a convertible holder, you are protected by the bond-like features of that convertible. So this ability for convertibles to participate in a majority of the equity upside while only suffering a portion of the downside is what creates this positively asymmetric profile that is a key attribute of the asset class. Given this positively asymmetric return profile, convertibles should generate equity-like returns with less risk over time. And on page 10, you can see that over the last 48 years, convertibles have delivered on the return side of that equation, as the asset class has actually outperformed the S&P 500 over time. Incorporating risk into the equation, and to further establish credibility for the asset class, we can see on page 11 that over the past 18 years, which goes back to when Barclays launched their convertible index, convertibles have generated better risk-adjusted returns in both equities, as represented by the S&P 500 and Russell 2000, and fixed income, as represented by US high yield, US investment grade credit, and US 5 to 7 year treasuries. Turning the conversation to more recent market dynamics, the asset class has experienced significant momentum over the past 18 months, as Scott alluded to, on the heels of compelling performance and a record-setting amount of new issuance. On this slide, you can see how both the market has grown and how issuance has surged. To provide some historical context, issuance had been trending in a very positive direction since 2012, which was a trough year for the primary market. Typically, a healthy amount of new convertible issuance for any calendar year would fall in somewhere in the 80 to $100 billion range. As you can tell from the blue line in the chart on the right, average global issuance, in fact, was at the high end of that 80 to $100 billion range from 2012 to 2019. Then last year came around and convertibles were issued at an historic pace, culminating in a year that saw $166 billion of new paper enter the market. This increase was primarily driven by companies at the time looking for a liquidity bridge given the uncertainty ahead. This historic pace has actually continued through the first 5 months of 2021, as $89 billion has already been issued, which is the largest amount issued in the first 5 months of any year on record. As a result, the size of the global convertible market has dramatically increased and now stands at roughly $700 billion. Not only is the strength of the primary market and the growth in the overall convertible universe been encouraging and exciting, but also we have welcomed the increased sector diversification that has resulted from all of this new paper. Looking at the chart on the left-hand side, you can see that more and more consumer-oriented companies have entered the convertible market over the past few years. As a result, the consumer sector has exactly doubled in size in the last 2 years and now represents 15.5% of the broader US convertible market. The other takeaway is that while new issuance has been driven by many innovative and disruptor companies whose names you can see on the chart on the right, we've also seen a number of deals from several larger, more mature issuers, such as Ford and Viacom. So one question we're often asked by investors and consultants, how is liquidity in this over-the-counter, more nuanced market? And our answer is usually fairly eye-opening for those not as familiar with convertibles. As you can see from the chart on the left, liquidity is strong in the convertible market and compares quite favorably versus a larger market like high yield. What helps drive this strong liquidity profile is the fact that every convertible we own is tied to a public equity. And so the broker dealers we transact with, who these days are not allowed to assume a lot of risk on their balance sheets, if any, are much more apt to buy $30 million of a convertible than they would be to buy $30 million of a private high yield issuer. Because when they buy that convertible, they can neutralize their equity risk by shorting stock or options against it and can therefore naturally hedge themselves. They can't implement that same natural hedge on the high yield position. One of the other attributes of the convertible asset class is its relatively low historical default rate. As you can see, the convertible default rate over the last 23 years has been just north of 1%, meaningfully lower than default rates seen in the high yield and leveraged loan markets. Over the years, and particularly since the crisis, there has also been a significant positive structural transformation in the convertible market, which has been further solidified by the dramatic shift in the buyers of convertibles. Heading into the global financial crisis, you can see on page 17 that roughly 3/4 of convertible investors were hedge funds or prop desks, with the remaining quarter being comprised of traditional long-only investors. To put some additional numbers around it, heading into 2008, there were nearly 200 relevant convertible arbitrage hedge funds and prop desks. And because convertible arbitrage at the time was a core allocation for most hedge fund investors and was a low volatility strategy that consistently cranked out singles and doubles from a return perspective, these 200 investors got very highly levered, could have been anywhere from 3 to 8 times. And then 2008 happened, and the reaction in the convertible market was not dissimilar to the reaction we saw in other markets as investors were fleeing for the exits and there was a sell at any price mentality. That reaction, coupled with the Dodd-Frank regulations, led many of these hedge fund investors and prop desks to shut down. So fast forward to today, the market is now much more heavily skewed towards long-only investors. While Barclays is nice enough to provide these statistics for us, they do not capture the market outside the US, which is dominated by long-only investors. As a result, we would argue that these numbers are more like 75% in favor of long-only investors currently. And this seismic shift in the buyers of convertibles has led to dramatically less leverage in the system. As those 200 investors who were between 3 and 8 times levered are now 15 to 20 relevant convert arb funds who are typically no more than 3 times levered. Not only is it a healthier and more stable market, but it's also fraught with inefficiencies, which firms who are dialed into the asset class can capitalize on. Okay, so now let's discuss one of the more frequent questions we get from investors. Where do convertibles fit within a diversified portfolio? First, before we go into the slides, I will share that amongst our current clients, it's fairly evenly split between 3 buckets. The first being equities, the second being fixed income, and the third being a separate bucket just for convertibles. While David Hume will momentarily walk you through the 2 primary long-only strategies we offer, one being the more bond-like and the other being more equity sensitive, I will tell you that the majority of our clients, as Scott mentioned, use our more bond-like strategy called Phoenix as an enhanced fixed income strategy, and our more traditional equity sensitive strategy called Balance as a defensive equity exposure. In addition, for those investors who have credit quality constraints, convertible mandates can be tailored with those restrictions in mind, as nearly 25% of the market is of investment grade quality. As Scott also alluded to, we offer US and global long-only strategies. So the bottom line is there's plenty of flexibility within the asset class to customize the solution that makes sense. So in addition to answering the fit question by suggesting convertibles could be included in your equity or fixed income buckets or put in their own separate bucket, we also wanted to get a bit more granular and share 2 specific implementation ideas. So moving to slide 20, we first wanted to discuss potential implementation within your equity portfolio. And before discussing a specific implementation idea, we thought it would first make sense to highlight the positive asymmetry convertibles have achieved over time. In this analysis, on the bottom half of the page, we have gone back to 1995, which is when our firm was founded, and looked at how the broad convertible market has done relative to equities, focusing in specifically on upside downside capture. Looking at the numbers in the red circle, the broad convert market has captured 93% of the equity market upside while only suffering 63% of the downside. This positively asymmetric return profile is a key feature of convertibles and is a big reason many of our clients utilize long-only converts as a defensive equity allocation within their equity portfolio. This attribute is even more relevant now as investors remain uncertain as to whether equity markets can continue to rise. I should also mention that David will walk you through in a few minutes how layering in active management further improves the downside protection available within convertibles. In terms of a specific implementation idea, just moving to the next slide. In addition to suggesting replacing a portion of an equity portfolio with defensive equity strategies like convertibles, we also wanted to bring a more granular solution to the table. Interestingly enough, when you blend low vol equity and long only convertibles together, as we've done in the 2 tables on this slide, you will see in the bolded font that over 10 and 20 year periods, a 50-50 split would generate a higher Sharpe ratio than you would have achieved by investing in either asset class on a standalone basis. We find that to be very compelling. And this is primarily driven by the minimal issuer overlap between companies with low vol equities and more growth-oriented convertible issuers. As I mentioned earlier, long-only convertibles are also used by our clients as an enhanced fixed income strategy. On this slide, we highlight the trade-offs between convertibles and core fixed income, and in exchange for a modest give-up in current yield, investors can access through convertibles a much shorter duration instrument with equity optionality. We think going forward, this is a very important consideration, as core fixed income has benefited from the tailwind of interest rates moving lower by over 500 basis points over the past 30 years and has much more embedded interest rate risk moving forward. An additional benefit to utilizing a shorter duration fixed income instrument with equity optionality in your fixed income portfolio is that convertibles can provide an additional buffer against the threat of rising rates. We have looked here on this slide at all periods since the bank loan index started in 1992, when the 10-year treasury yield increased by at least 100 basis points, and then examine the performance of convertibles and other fixed income asset classes during these periods. You will notice that convertibles, while not always the top performer, are amongst the top performers in nearly every period. The two main reasons for this are: one, typically when interest rates are rising, equity markets are appreciating, and so the embedded option component of the convertible increases in value since it's tied to movements in the underlying equity. And two, given the shorter duration profile we just discussed, convertibles suffer less than these other fixed income instruments other than bank loans, which, despite their floating rate feature, only outperformed convertibles in one of these 11 periods. That point serves as a good segue into our fixed income implementation idea. In addition to suggesting convertibles as a high yield alternative, given their lower default rates, shorter duration profile, and superior risk-adjusted returns, another interesting implementation idea would be either substituting or complementing bank loans with convertibles as a way to further diversify your fixed income portfolio with another asset class that typically performs well in periods of rising interest rates. As you can tell from looking at the Sharpe ratios on this slide, convertibles have actually generated better absolute returns and Sharpe ratios than leverage loans over the past 10 and 20-year periods. We also know that the topic of inflation is timely, as investors are concerned about it moving forward. While as a bottom-up shop, we do not have a strong view on where inflation is headed, we did examine how convertibles have performed during inflationary periods, and the results are shown here in the bottom row of this table. In these 4 inflationary periods, convertibles have outperformed both equities and bonds on an annualized basis by significant margins. While we believe in convertibles as a strategic part of an investor's asset allocation, if other investors wanted or needed to make a more tactical argument for investing in convertibles, then performance during inflationary periods would not be a bad place to start. Despite the asset class garnering more attention recently and its long-term track record of delivering superior Sharpe ratios relative to broad equity and fixed income indices, convertibles remain an undercrowded and overlooked asset class. Why is that? Is something we are often asked by our existing clients. First, there are not a lot of managers who are focused predominantly on convertibles. And for those managers where convertibles are one small part of a much broader platform, frankly, their business development teams are not usually well-versed on how to position convertibles. Second, consultants, who we all know are an extremely important gatekeeper in the asset management community, have their own set of challenges. While we have relationships with the majority of those consultants, the larger ones have a harder time covering this hybrid asset class. First, do convertibles sit with their equity or fixed income research teams? If they sit with their fixed income teams, which in most cases they do, then when their clients are interested in exploring defensive equity alternatives, how do convertibles enter the fray if the equity research teams don't cover the asset class? Next, many of the consultants, by no fault of their own, do not have off-the-shelf models that can properly account for convertibles' downside protection, so it's not often included in model portfolios. Lastly, some of the larger consultants we work with oftentimes are extremely busy and do not have the bandwidth to spend a lot of time on convertibles especially if they don't think they can leverage that work by recommending the investment to a large proportion of their clients. So it becomes incumbent upon us and other convertible focused managers to get the word out, host educational sessions with consultants and investors and their investment committees directly, and get those investors interested enough to push their consultants to do more work. While, as Scott alluded to, we've seen a meaningful pickup in institutional and retail interest and allocations over the last 12 months, convertibles still remain overlooked, which in fact presents an opportunity for those investors willing to take a deeper dive. With that, I'll turn it over to David Hume to discuss our two primary long-only approaches to convertibles, and I look forward to the Q&A period and any subsequent follow-up discussions in the coming weeks and months. Thank you.
Just briefly, before we turn it over to David, I would just encourage people, I've already seen a couple questions in the Q&A. If, just a reminder, at the bottom of your screen, there's that Q&A button. If you have questions, just feel free to type them in and we'll get to these. So, David.
Thank you, Scott. Thank you, Craig. So I'm going to be talking about our balance strategy and our Phoenix strategy. First of all, our balance strategy, which is the more equity sensitive strategy. This is a strategy that is used typically as a defensive equity component of an investor portfolio. What we're aiming to achieve in the balance strategy is to deliver equity-like returns with lower risks than common stocks. And we do it by focusing on the natural asymmetry within the convertible market. So we look for convertibles that have attractive risk reward profiles. We're looking to capture at least 75% of the underlying stock upside and limiting the downside risk to approximately 50%. Now, we take a credit first approach to the convertible asset class. We believe that this is very valuable in terms of ensuring that the companies that we invest in have the ability to repay us at maturity if the bonds don't convert into equity, but also that they will hold up on the downside through market volatility or if the share price should correct. And we run fully diversified portfolios, typical position sizes between 1% and 3%, and we have a maximum of 5%. Next slide, please. So this goes back to the convertible price chart that Craig explained earlier on. And the green box, or green shaded area, shows where the balance strategy focuses its attention. So this part of the market is typically where most of the new issues come to the market. And new issues typically have 5 to 7 years to maturity with significant levels of call protection, typically the life of the security. And so we focus on that middle part of the curve where you derive this asymmetry. Now, as the bonds appreciate and due to the underlying stock going up, you move to the right-hand side of the chart and the bond becomes more equity-like and less bond-like and has less downside protection. So we tend to scale out of positions that move to the right-hand side of the chart in favor of positions that we can buy within the green box range. Equally, if a stock has failed to perform and the bond is held up on the downside as you move to the left-hand side of the chart, we may well sell out of that position in order to reinvest the proceeds within the green box range. So we're trying to keep the maximum asymmetry within the portfolio at all times. Next slide, please. So over time, we have over a 25-year track record in the balance strategy. And you can see that over time, we have delivered on the goal of equity-like returns with lower risk. The since inception return around 10.6%, which has outperformed both the convertible benchmarks as well as the major equity indices, and with a lower standard deviation profile than equities. Next slide, please. And then in terms of comparing to the broader market in terms of upside downside capture, so the broader market captured 93% of the upside, but 63% of the downside years. And so in our balance strategy with active management and focusing on that middle part of the convertible curve, we've managed to capture a similar level of upside at 90%, but considerably less downside, just 46% of the S&P 500 in the downside years. So you see that natural asymmetry in the convertible market and in the balance strategy in particular. Next slide. So I'm now going to talk about our Phoenix strategy. So our Phoenix strategy is a more bond-like strategy there are less asset managers focusing on this part of the convertible market. And the strategy has a strict buy and sell discipline and is aiming to deliver attractive total risk-adjusted returns. And it focuses on investing in convertibles that trade no greater than 20% above the fixed income value or straight bond value. And so this gives a high level of downside protection, but also the ability to benefit from a rebound in the underlying stock via the undervalued option within the convertible structure. So again, you get positive asymmetry, but it's a more defensive form of asymmetry. And often you're investing in out of favor issuers where something has temporarily set back the stock price, but where you have the potential for a rebound over time. Next slide, please. And so going back to that convertible price chart again, so the green box range for the Phoenix strategy is to the left of where it is for the balance strategy. So you have a higher bond content, so you're much closer to that bond value. And for the Phoenix strategy, the sell discipline is to scale out of securities that have appreciated to more than 30% above that bond value. And so the Phoenix strategy preserves its downside protection levels by scaling out of those positions and then reinvesting in companies that fall within the green box range. And both of our strategies avoid the distressed part of the convertible market, so to the extreme left of the chart. Next slide, please. And so it's worth looking at some of the characteristics of the Phoenix strategy. So it's an equity linked strategy, and the broader convertible market has a beta to the S&P 500 of about 0.7. Now the Phoenix strategy, despite investing in equity linked securities, has a beta of just 0.4, which is similar to that of high yield. And yet its standard deviation is less than that of high yield. So just 8.1%. And then it's also worth comparing the Phoenix strategy against some of the major bond indices. So the duration of Phoenix, despite it focusing on the most bond-like part of the convertible market, it has a duration of just 2.8 years. So that compares very favorably to the duration of the major indices and addresses many investors' concern that with lower yields, that there's more duration risk in bond markets than there have been in previous years. Next slide, please. So the Phoenix strategy, again, has a very long track record over 25 years. And since inception has delivered an 8.5% annualized return, which has beaten the high yield market and has performed favorably, especially on a risk-adjusted basis relative to equities. And the standard deviation of the strategy is just over 8%, which is less than the high yield market and about half of that of the S&P 500. Next slide, please. And then just looking at the upside downside capture. So the Phoenix strategy is a more defensive strategy, so it doesn't capture as much of the upside, but still has captured 59% of the upside years of the S&P 500. And on the downside has only had 3 down years in its history, and actually on average has had a positive return averaged across the downside years of the S&P 500. So very significant asymmetry in the Phoenix strategy as well. Thanks very much.
Yeah, so thank you, David. So what I'd like to do is to provide just a quick overview and then open up. We've already got, like I said, we've got some good questions that have popped in. But just as a reminder, as you all know, we're specialists in this space. We've been doing this for a very, very long time across multiple market cycles. And as I mentioned briefly at the beginning, we've seen very, very strong interest across the firm. As I mentioned, the firm today is kind of at peak AUM. We've actually seen close to $2.5 billion of gross inflows in the last really year and a half. So there's strong interest across the board. This is a hybrid security. It can be a challenge, but that's also the opportunity. The strategies we run allow allocators to use convertibles for a variety of different solutions for their portfolio. And I think that's really important to understand as we do this. It can be used for that equity sensitive, that low vol equity sensitive piece. It can be used as a more defensive piece. And also, as Craig mentioned, for the environment we're in today, there are a couple key things, a couple key factors that are relevant. One is inflation, fears of inflation. Convertibles do have a proven record, and Craig showed some data, and we're going to have an additional paper coming out in the not too distant future that will dig in much more detail into inflation. So we'll be happy to share that with people. The other question really for corporate pensions particular is the question of funding ratios. And we've done some work on that. So anyway, with that, really appreciate everyone's time and attention. I hope you found this to be valuable. And so what I'll do is maybe throw out a couple questions that have popped up in the chat room. First one, really, David, is I think directed to you. There's a specific question about energy. And there's an investor here who has energy restrictions. They mentioned that they have energy restrictions on their portfolio. And it's kind of a two-pronged question. One is, how much energy exposure do we currently have in our portfolios today? Very specific question. And then the other part, which is a broader question, is, do we have the ability to establish and run broader, call it ESG, sustainable portfolios?
So those are good questions. And the answer to the first question about energy is that it's a relatively small portion of the US and global convertible market. So it runs at around 2% or so of the US convertible market. And I would say that a portion of that is alternative energy. So sometimes people have restrictions on fossil fuels. In fact, some of our clients do, and we can implement blacklists to avoid certain issues for clients, or more broadly, if they're not able to invest in fossil fuels, we could customize a portfolio that excluded those types of companies. But the alternative energy area is an area that has seen increasing issuance in the convertible market. So that's something that we anticipate would grow as a proportion of the overall convertible market. And then in respect to ESG, we do take into account ESG factors as part of our investment process. This is something that's becoming a larger part of what we do at Advent. And so we can certainly discuss customized mandates that focus on that more granularly.
Great, thanks. And just I am part of the ESG committee as a sidebar, and I would echo what David said, which is we're spending a lot more time on this. And we certainly can provide much more information if people have specific questions. Another question I think, David, really directed at you. The broad convertible index has had a big run in the last 5 quarters, last 12 months, 5 quarters. We've seen sort of gross returns of the index of up over 50%. What's that mean for today? What's the opportunity set like today? Have I missed it? What are your thoughts going forward with respect to looking back in a big run in the asset class over the last year?
Well, that's another good question, Scott. So yes, convertibles had a very strong 2020, and it was a record year of issuance, and many companies issued convertibles when their stock prices were depressed as a result of pandemic restrictions. And many companies benefited from the pandemic, and there was definitely a move into growth stocks, and the convertible market has a significant proportion of growth equities. So these were all factors that drove up the market in 2020. And much of that has continued in 2021, although there's been a shift towards more value type equities than growth equities in the course of 2021. Now, the convertible market over the course of 2020, and also this has continued this year, has seen significant issuance from companies that are more value focused, more cyclical in nature. And so we think that this is beneficial in terms of diversifying the asset class and also helping with the outlook. Now, some of the top performers of 2020, and Tesla was a good example. So Tesla was a large weighting in the broad convertible market. Many of those securities went deep in the money and in fact have been converted out into equity. So they no longer are outstanding or a much smaller weighting. So for those that are concerned that there would be a significant sell-off in the market, that is mitigated by the fact that many of these deep in the money securities have actually converted away, and our balance strategy and our Phoenix strategy have a natural discipline of selling out of more deeply in the money securities and rebalancing back towards par, where you have a greater level of downside protection. So we believe that we can deliver asymmetric returns going forward as a result of focusing on structure. And we also think that the potential, there's been a lot of dispersion in terms of performance. We think there's a lot of potential within the asset class for focusing on individual bottom-up company analysis and looking for asymmetric securities that can deliver attractive total returns.
Great. And then maybe seeing a couple more questions pop in here. New issuance. So Craig spoke about in his slides, very, very strong new issuance across the board. So how has the record new issuance impacted or driven performance of the asset class in your opinion?
So new issues will typically come to the market cheaper than what is in the secondary market to induce people to purchase the new securities. And we've seen a great number of newcomers to the convertible market over the past 18 months or so. So that has given a more interesting opportunity set for investors to invest in. Now, there is an impact when you have a very high level of new issuance, particularly in a relatively short space of time. That does put pressure on secondary market valuations because investors have to sell something to buy these new issues. And so that can set up some very interesting opportunities in the secondary market as well. And we've definitely seen that phenomenon in a couple of months this year. So overall, we think a high level of issuance is a good thing for the market because the issues that come are typically 5 to 7 years in maturity. So you have a significant time frame to be able to access the equity potential of those securities. So, we think new issuance is a good thing. It can cause some indigestion, but it also rebalances the overall convertible market back towards par, which enhances the downside protection of the asset class.
Great. And just one quick question, final question, then we'll wrap it up. Craig, I think this is really more probably directed at you. And we've certainly alluded to this, but it's a good question, which is just as a portfolio manager with a diversified set of bonds and stocks, why should I consider convertibles? Maybe just a couple very specific thoughts about this would be great.
Sure. I think we get that a lot from a lot of the large investors we talk to, that already have diversified portfolios of stocks and bonds. Why bother with convertibles? And I'd say the one thing that you get with convertibles that you can't access through that portfolio of stocks and bonds is access to optionality. And then more specifically, it's one of the few cheap sources of long-term volatility that's out there. And without getting into too many details, what we mean by that is that when you buy a convertible security, you're buying a bond with a 4 to 7 year maturity, and you're also getting an embedded option that has that same 4 to 7 year maturity. If you were to try to buy that option in the listed options market, you would never really find it in the size and liquidity that you access it through the convertible package. And if you bought shorter dated options and continued to roll them forward, that exercise gets very expensive very quickly. So one of the inefficiencies in the convertible market is that volatility gets priced cheaply. Because when companies come to issue convertibles, volatility is this invisible good or natural resource that they're giving away to the market. So they're willing to price it cheaply to create demand. So we find that there's a lot of different moving parts to convertibles. We find that when we run more technical analyses for prospective investors and we put convertible return streams into the mix with their existing portfolios, that they tend to be either additive to returns or very risk reductive. And I'm not going to get into too many more details, but the one thing I would add lastly is that we have a dedicated risk management team that runs all sorts of special analyses on the convertible asset class, one of which is they run a regression analysis where they looked at the returns of stocks and the returns of bonds over the last 20 years and wanted to see how much of the convertible return comes from both. And the convertible return, annualized return over the last 22 years is 969 basis points, 9.69%. Of those 969 basis points, 353 of those cannot be explained by linkage to the S&P or the Barclays Ag. You take that one step further, and if you add high yield into the mix as a 3-factor regression, just given that most of the convertible market is below investment grade rated, you still have over 200 basis points of idiosyncratic alpha that comes from these different moving parts of a convertible, which again, at a later point, we would be, while I mentioned earlier, we conduct a lot of educational sessions with our clients and consultants, we can also take technical deep dives into the asset class with our risk management team, and we'll welcome those sorts of discussions to go into more detail on this topic.
Great, thank you. Great. Well, I'm gonna wrap it up there. I really appreciate everyone's good attendance here and interest in this asset class. And what I would just say is on this page, if you have any other questions, if you'd like a copy of this presentation, if you'd like a link of the video to maybe share with others, these things can all be provided. So you can either shoot a note to this client advisory at adventcap.com or just simply reach out to your Advent point of contact, whoever that may be, and they'd be happy to provide you with either or both of those links. So thank you very much, everybody. Have a great day, and we appreciate your time once again.